exam. I'm going to spend about a half hour on it, and then I'll go through the PowerPoint presentations, and then on Thursday when you come back, I'll probably finish the PowerPoints, then we'll break up into teams and bring some problems from the midterm take-home and the homeworks, and we'll work on those in teams. Okay. So first discussion on the exam is negative interest rate. What's the importance of understanding negative interest rates in the negative interest rate environment?
Are we doing the in-class exam or the take-home exam?
This is going to be the in-class.
Okay.
The take-home we'll do on Thursday. And we'll just, you'll pick some problems and we'll put them up on the board and we'll work through them. So what's the importance of negative interest rates? Currently, 25% of the globe is controlled, has negative interest rate regimes. What's the importance of that? Will negative interest rates have an impact at all on stock and bond prices? Will they have an impact on bond prices?
Yes.
Will they have an impact on the economy? Will they have an impact on financial institutions and markets? No? Yes?
Yes.
I'm looking for some dialogue here. Yes, so what would be the first impact of negative interest rates? Why did Japan and Europe implement negative interest rate monetary policy?
For the bonds?
Well, they bought bonds. Okay, what did that do to bond prices? They printed a bunch of money and they bought a bunch of bonds. They bought corporate bonds, they bought stocks, they bought sovereign bonds. And what did that do to stock and bond prices, particularly bond prices? If they print money and buy bonds, what happens to bond prices? If they print money and buy bonds, what happens to bond prices? They go up, okay? And in the process, interest rates go down. And by buying so many bonds and driving bond prices up so high, they drove nominal interest rates negative. Has that ever happened before in history? No. Okay, so you're living through history right now. And actually there's a lot of professors right now at some of the major universities that are rewriting the financial textbooks and the economic textbooks because we've never seen negative interest rate policy before, and we don't know the implications and ramifications on the economy, financial institutions, and financial markets. We don't know, okay? But the first thing that they try to do through negative interest rate policy is to devalue the currency. And what does that do to the value of the exports? If you devalue your currency, what happens to your exports? Do they become more or less expensive? Now, what we're doing here too, just so that you know, is this is a midterm oral exam. So I'm going to be seeing who is on top of it, who's actually learned stuff, who's actually engaging, who can give me feedback, and to be able to go through these, really a mock interview process. Because these are the type of questions that you'll probably get in an interview, and you need to be able to respond with the right answer very quickly. So the first effect of negative interest rate is to drive the currency down through devaluation, through depreciation. Does that make the exports more or less expensive? Less expensive. So is that supposed to stimulate exports? Yes. So it's supposed to stimulate exports. However, that's only a short-term phenomenon. So stimulation of the economy to get it to grow through devaluation of the currency and to be able to export is short-term. The long-term implications and ramifications associated with negative interest rate policy is that you have disintermediation in the financial institutions. Disintermediation. The banks are buying sovereign bonds with negative yields, and they are paying depositors positive interest rates. So they're getting negative yields on the bonds, and they have to pay out on the deposits. This is eating into the interest margins of the banks, causing them to have to put up more capital, lending less, and holding more cash, and basically not stimulating the economy. So there is a negative, what's called an accelerator multiplier effect. Also, investors and savers who are investing in these sovereign bonds are getting negative yields, which means that their standards of living are actually going down. They're buying bonds that are actually destroying wealth. So the three main causes of negative interest rates is devaluation of the currency, for one, which is the first effect. Second is disintermediation from financial institutions, lack of lending by financial institutions, the destruction of the financial institution stocks are actually going down in the process because they're having to pay out the depositors and then invest in bonds that are giving negative yields. And then the last one, the last effect, is that it creates asset price bubbles. Because what happens when you're using the Fisher equation to get to the risk-free rate, if you have negative inflation expectations, what does that do to nominal interest rates? It's actually going to cause them to go down and could cause them to go negative. So nominal interest rates are turning negative.
No.
In the capital asset pricing model,
No.
what's the very first variable in the capital asset pricing model? The risk-free rate. The risk-free rate. And if the risk-free rate is negative, what happens to the expected return and the cost of the equity? It goes down. It goes down. So if the discount rate goes down, what happens to the value of the stocks? If the discount rate goes down or expected rate of return goes down, what happens to the value of the stock? The discount rate goes down. Remember, earnings per share divided by I. The discount rate goes down, the value goes up, right? So if risk-free rates are going down, then the discount rate is going down, and the values are going up. So through negative interest rate policy, you are driving risk-free rates negative, and you are driving the cost of debt and equity to very low levels, which is creating asset price bubbles. So negative interest rates create and manifest asset price bubbles that could eventually pop. So in your book, when you're looking at the capital asset pricing model, it assumes like a 2 to 5% risk-free rate. Imagine if it was negative 2 to 5%. Rerun the equations with a negative risk-free rate. This has never been happening before. The books are going to have to be rewritten. The economic books are going to have to be rewritten. And we don't know what the long-term implications and ramifications are. And the Federal Reserve has basically said that they would implement negative interest rate policy if we went into a recession. So it would be horrible for the banks. It would be horrible for savers and investors who invest in those bonds. So that's why we go through this, because it's extremely important that you understand this. Yield curve dynamics. Yes.
Can we repeat the first two factors in the negative interest rate?
First is going to be the devaluation of the currency, because interest rates and the value of the currency are highly correlated to each other. That's why there's so much money coming into the United States, is because their interest rates are negative and ours are positive. So the first is devaluation of the currency to spur exports. The next is that the banks will buy negative interest rate sovereign bonds that have to pay depositors interest. So they're getting negative yield on the bonds and they're having to pay out, so that's going to eat into their interest margin, actually cause them to be less profitable and their stock prices to go down. And if the stock prices go down, their leverage ratios go up and they have to put up more capital. So banks are putting up more capital. People are also hoarding and holding large cash amounts, because why would you, it's better, you're better off holding cash than holding negative yielding bonds. Negative yielding bonds are destroying, you're not getting any return. At least when you're holding cash, you're actually getting a better return than buying the bonds. So these countries have huge cash balances. So the banks are holding money, people are holding money, and at negative interest rates, because you're getting nothing, it's supposed to spur people to consume more. But people aren't consuming more because interest rates are negative. Because that, using the Fisher equation, negative inflation expectations are causing nominal interest rates to be negative. Well, if inflation expectations are negative, what does that tell you about the future economy? If inflation expectations are negative, what does that tell you about the economy in the future? If prices are falling, are we in the growth peak phase of the business cycle, or are we in a recession? A recession. So basically, negative interest rate policy is signaling to the marketplace that we're going into a recession. So it's counter. The policies only work to devalue the currency in the short run. In the long run, they're
So
counterproductive.
isn't that just speeding up the recession?
Yeah, because people are holding back. They're not consuming and businesses aren't investing. Okay, and the banks aren't lending because they're holding huge cash balances and they're holding more equity. They're not lending out. So if you look at Japan, the negative interest rate policy is now actually not working. It worked for a little bit, but it's not working now. In Europe, it devalued the currency. It has worked to a certain degree, but in the long run, it's probably going to be counterproductive. So this is very perverse, unorthodox monetary policy. Let's talk about yield curve dynamics. Okay? Yield curve dynamics. What would shift the yield curve up using the Fisher equation? What would shift the yield curve up? What? Yeah, higher inflation expectations. Maybe high real rates, but in most cases it's going to be higher inflation expectations. And if you have higher inflation expectations and the yield curve shifts up, what happens to the risk-free rate? What happens to the risk-free rate? Is the yield curve the risk-free rate? Yes or no? Is the yield curve the risk-free rate? Yes or no? Let's get down to brass tacks. Is the yield curve the risk-free rate? Are the yields on treasuries by maturity the risk-free rate? Yes or no? Yes or no?
Yes.
Yes, they are. You need to memorize that because it's really interesting. I can get 2 months into a class and people still don't know that the yield curve is the risk-free rate. Still don't know the yield curve is the risk-free rate. So if the yield curve is the risk-free rate and the yield curves shift up due to higher inflation expectations, what happens to risk-free rates? They go up. What happens to the cost of debt and the cost of equity if the yield curve shifts up? If the yield curve shifts up, what happens to risk-free rates? They go up, okay? And if they go up, what happens to the cost of debt and equity? They go up. Okay, what's the first variable in the capital asset pricing model equation? What's the first variable? The risk-free rate. So if the yield curve shifts up and the risk-free rates go up, what happens to the expected rate of return on the equity or the cost of equity? Goes up. Goes up. And if the cost of the equity goes up, what happens to the value of the stocks? If the cost of the equity goes up, what happens to the value of the stock?
Goes down.
Goes down. Goes down. Remember the perpetuity model? What's the perpetuity model? What's the perpetuity model?
Cash flow T plus 1 over the interest rate.
And it's not the interest rate.
Oh, it's not.
No, it's the expected rate of return. Or it's the weighted average cost of capital. So these terminologies are interchangeable, but the evaluation equations are the same. Okay, so let's go through it one more time. If the yield curve shifts up, what happens to the risk-free rate?
Goes up.
Goes up. If the risk-free rate goes up, what happens to the cost of debt and equity? Goes up. And what happens to the values of stocks and bonds? Goes down. Exactly. Okay. So you need to memorize that. So the yield curve and the yield curve dynamics are extremely important because they have a direct effect on the cost of the debt and the equity and the expected return on the debt and the equity. And if the yield curve shifts up, the risk-free rate shifts up, the discount rate shifts up, and the value of the stocks and the bonds go down. Go for it, I'm sorry.
I think I'm getting the Fisher equation confused with when you say the capital allocation.
Yeah, what's the capital asset pricing model? What's the equation? There's two equations. The Fisher equation determines the risk-free rate. The risk-free rate is the first variable in the capital asset pricing model. So you have two models you have to memorize. Okay.
The risk-free rate plus the beta times expected market return minus the risk-free rate.
Exactly. Can you say that again? Everybody should be able to do that. Okay. Can you say that one more time a little louder?
The risk-free rate plus beta times expected market return minus the risk-free rate.
Exactly. That's the capital asset pricing model. So if the yield curve shifts up, what happens to the risk-free rates?
Goes up.
They go up. And what happens to the expected return on the equity? Goes up. And what happens to the value of the stock? Goes down. Okay. And if the yield curve shifts down, what happens to the risk-free rate? Goes down. What happens to the cost of the equity or the expected rate of return on the equity? Goes down. What happens to the value of the equity? Goes up. Okay. What is the equation for the risk-free rate?
Is that the interest rate equals the
Yeah, it's the Fisher equation. So you use the Fisher equation to determine the risk-free rate. And the risk-free rate is in the capital asset pricing model. This is what's really important about this, is that the yield curve is are the risk-free rates. They're in the capital asset pricing model, and they're in the risk premium, the premium model, to be able to calculate the expected return of the cost of the debt. The risk-free rate is in both of those equations. And when you want to calculate the weighted average cost of capital, you're going to use both of those models, which are then tied to the risk-free rate. So everything is linked together in the macro monetary policy. So movements in interest rates will have a direct effect on the value of the stocks and bonds through the risk-free rate, because they're both in the equation.
So you're saying that risk-free rate is the Fisher equation, but
Yes.
I wrote down interest rate equals real rate plus inflation expectation.
Yeah, the interest rate on US Treasury securities
Is the risk-free rate.
is the risk-free rate. Okay, is the risk-free rate. So there's interchangeable terminologies here, but it's really important that you understand that. That the yield curve, which is the yield to maturity by maturity on government bonds, are the risk-free rates. Okay, are the risk-free rates.
And then the inflation expectations just change like the slope of the yield curve?
Yeah, depending on the maturity.
Yeah.
Depending on the maturity. So real rates of return don't move that much. So any shift or any movement or any rotation in the yield curve is due to inflation expectations. Do people think we're going into a recession, or are we going to be in growth phase? Okay, and the inflation expectations are positive, zero, or negative when the slope is upward sloping, when it's normal. Positive. And when the yield curve is flat, is the inflation expectations positive, zero, or negative? Zero. And when the curve is inverted, the inflation expectations are negative. Okay, so people are anticipating a recession. If the curve inverts, when does the market peak? 12 months. When are we in a recession? So that's really what I was trying to get at. And I asked you in on the exam, if you can show me the equation for the risk premium, or premium model, to be able to determine the cost of the debt or the expected return on the debt. So can you give me what the equation is using the risk premium model to be able to determine the cost of the debt or the return on the debt? What's the very first variable in the risk premium model to arrive at the cost of debt and the expected return on the debt? It's the cost of the debt if you're coming at it from the firm standpoint. It's the return on the debt if you're coming at it from the investor. It's the same model, it's just different depending on who you are. It's the risk-free rate. And then what do? You start adding those premiums. Give me three. Credit default, maturity, and illiquidity. Okay, excellent. And then give me the capital asset pricing model again. What's the equation?
Risk-free rate.
Risk-free rate
Plus beta.
plus beta times
Expected market return.
expected market return
That's risk-free rate.
minus the risk-free rate. Okay. If we were to calculate a weighted average cost of capital to use as a discount rate, to be able to discount projects for capital budgeting, how would we calculate that? How would we calculate the WACC? We already know how to calculate the cost of the debt and the equity. We can use the risk premium approach to calculate the cost of the debt, capital asset pricing model to calculate the cost of the equity. Now what do we do to be able to come up with a weighted average cost of capital that we can use as the discount rate to discount cash flows on projects that we're looking to invest in? So how would we calculate the weighted average cost of capital?
You multiply the cost of the debt by the rate of the debt
Exactly.
plus the cost of equity times the rate of equity.
Exactly. Can I use the book value of the debt to calculate the weights?
But you gotta use
In the equity, can I use the book value of the debt and the equity to calculate the weights?
Yeah, but don't you usually add some basis points to be conservative?
No, that's on the discount rate, that's a different method. I'm trying to see if you understand how to calculate the weighted average cost of capital. Okay. Can I use the book value to calculate the weights of the debt and the equity? Yeah. Can I use the market value? Yeah, I can use both those approaches.
At this point, we're doing, also we want to, part.
Yeah, because I gotta do some PowerPoint presentations. Okay. Yeah, so you can use the book value or you can use the market value to get the weights.
How do you determine which one?
The book value is probably the easiest because you can go to the annual report and you already have the book value of the liabilities for the most current period, and you can calculate the weights that way using book value from the annual report. Okay. If you know the bonds that are outstanding and you know the prices of those bonds that are outstanding, you can calculate the market value of the bonds. If you know the shares outstanding for the stock and you know the current stock price, you can calculate the market value of the equity. Okay, and you may want to make a footnote too that you can use either book value or market value to get the weights to calculate the weighted average cost of capital. But theoretically, when you're calculating the weighted average cost of capital, you would use the target or the optimal capital structure. The target or the optimal capital structure to calculate the weights. Because the stock prices can go up randomly and end up increasing the weight of the equity. And it's not the target for the equity, it just happens that the market price of the stock went up significantly. Okay, so you have to be, and we'll get into this when we do the case studies on the back end, because we're going to be talking about optimal and target capital structures. Because if you can optimize the capital structure, what happens to your cost of capital? If you can optimize the capital structure, what happens to your cost of debt and equity? What happens to your weighted average cost of capital if you can get the capital structure optimized? It goes down. It goes down. And the spread between the internal rate of return and the WACC goes up. Goes up. Goes up. Exactly. Okay.
You're transferring the top ones.
Okay.
It's that projector's fried.
Oh, is it?
Yeah, I've never seen that status. It's blinking on a 20-time cycle. I've never seen that one.
I think I recovered pretty well.
You're doing
I think I
great.
handle myself. What do you think?
Doing great.
Thanks, you guys. Okay, what's the next one so we can keep going? What's the next question?
What impact do movements and shifts in the yield curve have on short-term and long-term interest rates and asset prices?
Yeah. So didn't we just talk about that? So shifts in the yield curve up are going to cause risk-free rates to do what? Go up, and it's going to cost the cost of the debt and the equity to go up, and it's going to cause the asset values of the stocks and the bonds to go down. Excellent.
Might have to use a different resolution to get it. It's really,
Yeah, it's pretty bad.
it's really good.
Let's talk about the modern portfolio theory. Okay, because again, I want to keep going because we're going to run out of time. When constructing a portfolio, why would you add alternative assets to your stock bond portfolio? Why would you add cash value life insurance or alternative renewable energy or, direct private equity to your stock bond portfolio?
Because you don't want correlation between things.
Yeah, because the rates of returns, the returns on those alternative assets have low, no, or negative correlation to rates of return on stocks and bonds. So they have low, no, or negative correlation.
Doesn't it also like diversify your portfolio?
Exactly, and it would also diversify your portfolio. Yep. And the diversification, how is the diversification manifested in the efficient frontier? What does it do if I add cash value life insurance, alternative renewables, direct private equity real estate in my stock bond portfolio? What does it do to the efficient frontier? What?
Bars it out.
It bows it out, okay? It bows it out. And in the process, do you get a lower expected rate of return on the portfolio? Do you get a lower expected rate of return on the portfolio? Does it reduce the expected return on the portfolio by adding these alternatives to the stock bond portfolio? Yes, it does.
Wait,
Isn't
doesn't it
it-
increase the return?
It lowers the return.
So
It
why
lowers
would
the
you do
return.
it?
Why would you add alternatives? We're gonna keep going here. Why would you add alternatives to a stock bond portfolio if it lowers the expected rate of return on the portfolio?
Lowers the risk.
It lowers the risk more than the reduction in the rate of return. It lowers the, maybe you went from a 10% expected return on your portfolio to 8%. Do you still want the portfolio? Yeah, because what's gonna happen to the portfolio values? If you're getting an 8% rate of return as opposed to a 10, what happens to the value of the portfolio in less than 10 years? It's gonna double, okay? It's gonna double. So maybe it doesn't double in 9.5 years, but maybe it doubles in 8 years or 7 years. Would you still take an 8% rate of return? Yeah, but if I can reduce the portfolio standard deviation significantly more than the reduction in the return, are we better off?
Does the risk?
Am I
stay the
better
same?
off? Because what happens?
Does the risk stay the same even when it doubles?
Doesn't that-
Or does the risk double with it?
No, the risk-free rate, sorry, I forgot the risk-free rate. Expected return on the portfolio goes down. Portfolio standard deviation goes down even more. Are we better off?
Yeah.
We're better off. Because what happens to the risk-adjusted rate of return?
Goes up.
Goes up.
Well, I was saying like in 7 to 10 years, you say it doubles, what happens to the risk rate? Does it,
This is 8%. Do I really care if it's 10% or 8%? If I'm getting huge reduction in the risk in the portfolio, do I really care if I'm gonna get it, and I don't get a 10%, and I only get an 8? My money's still gonna double in less than 10 years, do I really care? No, I'm getting diversification benefits by adding the alternatives to the stock bond portfolio. It's gonna bow out the efficient frontier, but it's gonna reduce the expected return on the portfolio. But the reduction in the portfolio risk is gonna be significantly reduced, way more than the reduction in the return. So I'm better off as a risk-averse investor by adding these alternatives to my stock bond portfolio. So what I wanna see in that graph, a lot of you didn't show me the bowing out of the efficient frontier. You didn't show me the reduction in return and the significant reduction in the portfolio standard deviation. So I'm really looking for those details, because you may end up teaching this stuff someday. And I wanna see the lines. You know, they go from return to 100% stock portfolio, bond portfolio, show me how to move up the efficient frontier, you know, by selling your bonds and buying more stock to get more return, but you're taking on more risk. How you can move down the efficient frontier by selling the stocks and buying more bonds. Yes, you're gonna get lower return, but you're gonna get significantly less risk. And how you can jump off the efficient frontier and move up the capital allocation line by adding margin to your stock portfolio or mortgage finance to your real estate. How you can move down the capital allocation line through the process of lending or writing contracts. I don't think I asked you in there, if I apply derivatives, if I write forward contracts and futures contracts and buy calls on futures, and maybe buy puts on futures, can I hedge the portfolio? If I write forwards and futures and, you know, if I write calls and buy puts, can I hedge the portfolio? The value decline? Yeah. Yeah, so if it's in there, yeah. So if I apply the derivatives, if I write the forwards, and if I write the futures, and I buy the puts on the futures, and write the calls on the futures, if the values go down, don't I get money from the derivative contracts? And wouldn't that compensate me for the loss in the value of the portfolio? So theoretically, not only adding alternatives to your stock bond portfolio, but applying the derivative contracts also bows out the efficient frontier. because the derivative contracts cost money. So you can hedge or diversify your portfolio by adding the alternatives, but you can also do it by buying the puts and writing the calls, or writing the forward contracts, or writing the futures on the indexes. Any questions on that? Go
So
for it.
adding alternatives and applying the derivative contract is what goes that?
Yes.
And so in the, when we draw it, is it like, are you showing it barred out, or are you showing
Yeah,
it?
yeah,
the
so
movement?
it gets a little tricky, right? So, just do it over here.
I don't know why that projector's got such a horrible image and it's plugged in via HDMI. It's just, no matter what we do to blow it up, it's not really.
Okay, well, let's just try the PowerPoints and see if they work. So let's do it here. So here's the, and this is what you want to do when you want to set up the capital allocation line. You want to set up the efficient frontier. Don't forget the utility curves. And this is going to be your market basket. And what happens is when you add the alternatives or apply the derivatives to the portfolio, it's going to bow out the efficient frontier. So it bows it out like that. So you're going to get a reduction in the return, but your reduction in the portfolio standard deviation is going to be significantly more. So that your risk-adjusted rate of return is going to go up. So you're better off. And this is how portfolio managers do it. Okay? This is how stock portfolio managers do it. They don't have the alternatives, they just use the derivative contracts to hedge the portfolio. Multi-asset portfolio managers will add in the insurance, add in the real estate, and add in the alternative renewable energy to be able to bow out the efficient frontier.
It doesn't go out the other way at all?
No,
Just
it
that
goes that way. Goes that way. Okay? All right. Having a little technical difficulty here, obviously. I think I'm handling it pretty well. No nervous breakdown. So we went through yield curve dynamics. So let's keep going. How am I doing on time? Because I'm gonna.
46.
Okay. All right. So we talked about yield curve dynamics, discount rate determination. Discount rate determination. Again, risk premium approach, capital asset pricing model, weights in the capital structure to calculate the weighted average cost of capital.
Professor, where is that on there?
Oh, sorry about that. Okay, I got it. Okay, I apologize. That was wrong. Let's go into intrinsic valuation theory. Okay. So, what's the perpetuity model?
Cash flow, T plus one,
Oh, right. Okay. And cash flow T plus one, can we use EBITDA? Can we use EBITDA? For instance, before interest, taxes, depreciation, amortization is the numerator as the cash flow. Can we use EBITDA?
Yeah.
Yes. Can we use EBITDA per share? Can I use EBITDA per share?
Yeah.
Yeah. Can I use earnings to value the firm? Can I use earnings per share to value the stock?
Yes.
Okay. But you always remember you have to use next year's. Not last year's, not this year's, but next year's cash flow projections. I can be what? What's the terminology behind I? What could I mean? What does I mean?
expected return,
Expected return,
interest rate.
Not interest rate, remember the interest rate is in the risk-free rate. Okay, if you're valuing sovereign bonds, or government bond, then would I use the US Treasury yield? Yeah, so I would use interest rates if I'm valuing US government securities, okay? But that's not what we're doing in most cases. We are valuing the stock, or we're valuing the company, or we're valuing the piece of real estate, okay? So let's say we have earnings per share, all right? What is I again? You said it? Expected return, okay? If the cash flow is, free cash flow is EBITDA, what would I be? It could also be called the discount rate. Yeah, I'm looking for different terminologies. If I'm calculating the weighted average cost of capital, can I use the weighted average cost of capital as a discount rate? If I'm doing present value calculations to figure out the value of future cash flows on a piece of real estate or a company, can I use the weighted average cost of capital as the discount rate? Yeah. If I'm valuing a firm, or if I'm valuing a stock, and I use the Gordon growth model, what's the Gordon growth model? Yeah, cash flow T plus 1, I minus G. Okay, and what does the G assume? Constant growth rate of what?
Company in the future.
No. What are you assuming in the Gordon growth equation? What does G tell you about the cash flows? They grow at a constant rate forever. Exactly. Thank you. Yeah, they grow at a constant rate forever. All right. And if I goes up, what happens to the value? Goes down. And if G goes up, what happens to the value? Goes up. And if G goes down, what happens to the value? Goes down. Okay. The multiple approach. Tell me the multiple approach.
CFO,
Cash flow,
T plus 1,
next year's,
times M,
times M.
T plus 1.
So future multiple
Yeah.
equals the value. Okay. And then give me 3 examples of the multiple. How can I calculate the multiples? Give me 3 approaches.
I minus G.
Yeah, I could use 1 divided by I,
Oh, 1 divided by I minus G.
or 1 divided by I minus G. And what's another metric that I could use as a multiple?
Could you just use I?
You know, I could use 1 divided by I to get a multiple. I can use 1 divided by I minus G to get a multiple. There's one more approach.
P over E.
Yeah, P over E, which is price earnings. Price to earnings per share. So it's the PE multiple. So I could use the 3. Okay. And then tell me about the discounted cash flow methodology. Walk me through it. If I was asked to value a stock or a piece of real estate or a company, walk me through the steps of a discounted cash flow analysis.
Yeah, it has a value.
Okay, that's the ultimate objective, is to get to the present value. But walk me through the discounted cash flow. If you were asked in an interview, do you understand what a discounted cash flow is? Can you walk me through the procedures in which you would go through to be able to arrive at the present value? Can you walk me through it?
Don't you have the cash flow and then you multiply it by, like, in this case, we multiplied it by 1.02 because it was 2% growth.
Okay, so you would come up with some base period cash flow and then grow it out to the first year, right? And then what would you do after that?
You multiply the forecast out.
You forecast out the cash flows. So let's say it's a 5-year holding period. Then what would you do?
You choose Gordon growth or perpetuity.
Would I grow it out one more year, or would I use the last year in the holding period's cash flow to get the terminal value? You grow it out one more year, and then I would apply what model?
Gordon growth.
Or perpetuity, and if I apply perpetuity, what am I assuming about the cash flows? Yeah, they're gonna be flat forever. And if I apply Gordon growth, they're gonna grow at a constant rate. Okay, so once I get the terminal value, then what do I do with that? Add it to the last year in the holding period, and then what do I do with those 5 years of cash flows? Yeah, you're gonna calculate the what?
It's the one plus the rate.
Yeah, what do we then do with the cash flows?
Divide by the discount
Right,
rate.
Yeah, but we have to calculate the discount factors. Okay, write that in. Then you apply the discount factors.
what's that part?
The discount factors,
Is that the part of the?
it's underneath the cash flows, so it's, if
Yes,
it's
right.
10%, it's 1.1 to the 1, 1.1 to the 2.
Yeah.
So then you calculate the discount factors for each year in the holding period. Then you discount the cash flow, then you add up the discounted cash flows to get the present value. Okay. And if the present value is higher than the price of the cost, you accept or reject the project. You accept it. Okay. If the net present value is positive, do you accept or reject? Accept. If it's negative, reject. Okay. And then we'll go through that stuff when we get into the case studies. But I want you to know perpetuity, growth, multiple, and DCF.
You said that was gonna be on the in-class, is that, do we have to do like an evaluation thing on the in-class?
Yeah, I have a couple case studies.
Is it
yeah.
on the in-class then?
Yeah, it's on the in-class. Yeah, because again, a lot of this stuff, what?
Or we're going through it for one by ourselves?
What?
On the in-class test, are we doing one of those by ourselves?
Yeah, I'm gonna have you do, go into the case studies.
Okay.
But I want to test you to see if you know the model structures
Uh-huh.
for the valuation models.
Okay.
Okay, first, which I think you do. And then we'll get into the case studies. And let's go through those now, because I'm gonna walk you through it so there's no confusion. To make it faster so you can do the calculations. All right, so have the investment banking and the technology company up, and then go to the assumptions. So again, this is gonna be a large cap tech company. The free cash flow last year was $200 million. So what are we gonna do with the cash flow?
Throw it out.
We're gonna grow it out, okay, until you get to the first year. So underneath it, I have the free cash flow growth rate, the going in to be able to apply the Gordon growth model, and I have the terminal, so that you can use the growth rate, the Gordon growth model on the back end, okay? We have the weighted average cost of capital. In this case, the capital structure is 70-30. I'm not gonna have you calculate the weighted average cost of capital. I already gave it to you, okay? I gave you the going in whack, and I gave you the terminal whack. So you already know the terminal G and the terminal whack. The terminal discount rate is 24%, and the growth rate is 3, so you just need to subtract it, and then apply it to the 6-year cash flow. You have the discount rate, which is 22%. So this is a pretty risky company, right? Our expected return on this is 22%. It's not 8 or 10. The pro forma cash flow growth rates, 20%, 18, 15, 12, 6, and 3. So I actually show you the growth rates going out 6 years.
So is that like the 1.2, 1.18 on the bottom?
No, that's not the, those are the growth rates in the numerators. So for each year,
Okay.
so you're gonna take the 200 million, last year's free cash flow, and multiply it by 1.2. Right, to get the first year in the discount period. Does that all make sense? Last year's 200
Yeah.
million in free cash flow. First growth rate, we think we can grow the cash flows
Yeah.
from last year to this year by 20%.
Yeah.
And then it's gonna go 18, 15, 12, 6, and 3. So I've already given you the growth rates, all right? And then the cost of the acquisition of the target company is $4 billion. Okay, so I already give you that so you can calculate the net present value. So you're gonna have to calculate out the cash, grow out the cash flows, calculate the terminal value, add it back to the last year, the 5th year. You're gonna have to discount those back to get the present value. Then you're gonna subtract the acquisition price to get the net present value. If it's positive, what do? You accept it. If it's 0, accept it. If it's negative, reject it. What would you, if it's negative and we really want it, what would you do? If the net present value was negative, what iterations would you go through?
See if the market value is correct.
No, let's go through the iterations, okay? So we did the analysis and the net present value is negative. What's the first thing we do? No. It's the first thing we do. We have a negative net present value. What's the first thing we do? No, that's the second.
Renegotiate?
You'd renegotiate. So we'd go back and we'd ask for a price reduction in the amount of the negative net present value. You need to write this down. Okay, you need to write these down. The second iteration, what would that be? The first iteration is to do the analysis. The second iteration is to ask for the price reduction or reduce the costs. The third iteration is what? What do you do next? We still want this project. I can't get a price reduction. So then what do we do?
Have capital structure.
Find net present value?
No, that's the fourth one.
Check the data.
Check your assumptions and give me the variables that you would audit. Tell me what you would audit.
Risk premiums.
So we would,
Capital structure.
we would look at the capital structure. We would look at the risk premiums. If I would, I didn't ask you to do this because I gave you the WACC, but you would look at your cost of debt assumptions. What else would you look at? Would I look at the cost of equity assumptions? Would I go back and look at CAPM? Would I go back and look at risk premium? Would I go back and look at the yield curve and the forward curve and see if I use the right risk-free rate? What else would I do? So that's the discount rate. What else would I go back and look at?
I'm not sure what you said.
A lot of them are right here in the assumptions. So we already did the WACC. Now we already did the discount rate. What else would we look at? If I use too high of a WACC, what happens to the present value? If I use too high of a discount rate, what happens to the present value? If I use too high of a discount rate, what happens to the present value?
Too low.
It goes down. And what happens to the net present value?
Goes down.
Goes down, okay? So could I have used too high of a discount rate? Yep, so I gotta audit that. Now, what other variables within the discounted cash flow model would I go back and audit to see if I made a mistake? What? The growth rate in the cash flows, exactly. So maybe, did I underestimate or overestimate the growth rates? Do I underestimate them or overestimate them? I underestimated them. Because if I underestimated them, is the present value gonna be higher or lower? Lower. Is the net present value gonna be higher or lower? Lower, okay? So now we have the growth rate. What's the next one? What other variables in the model should we go back and audit?
The market risk, or the market.
No, now we're in the discounted cash flow model. So we already audited the discount rate, we've audited the growth rates. What else do we need to go back and look at? No, we already did the discount rate. What's the most critical step in the discounted cash flow model? The most critical step? The terminal value, okay? And what variables did we assume in the terminal value? I minus G. So could we have overestimated or underestimated the terminal discount rate? If we're getting lower present values or negative net present values, did we over or underestimate the terminal discount rate?
Underestimate.
Did we underestimate it? Is it too low or too high? Is it too low or too high? Is it too low or too high? It's too high. It's too high. Because if the discount rate is high, the terminal value goes down, present value goes down, and the net present value goes down. Okay. This is how the underwriters basically get by in pushing projects through that are net present value negative. This is how they do it. Is they basically inflate the terminal value because the board does not understand terminal value calculations. And they don't even look at the pro formas out 10 years and look at the terminal value. So the acquisition team inflates the present value and the net present value to get projects to be accepted that otherwise should be rejected. And then those companies and those projects fail in the future and cost the company millions or billions of dollars. Why? Because how are they compensated? How are the investment bankers and the acquisitions people within Google and Oracle, if you're on the mergers and acquisitions team, how are you compensated? You're compensated by doing deals, right? And the more deals you do and the bigger the deals, the bigger compensation you're gonna get. So do you have an incentive to inflate the terminal value, to increase the present value and net present value on these projects, to get them accepted?
Yeah.
Because how big do you think your bonus is gonna be?
Huge.
Like $1 million, maybe. So it's all in the terminal value, okay? So we could have overinflated the terminal discount rate. What else could we have done? Over, under inflated, or over, underestimated the growth rate. Underestimated the growth rate in the Gordon growth model in the terminal valuation.
So if you're doing that and then it's under the net present value, and then you just change it from the perpetuity model to the Gordon growth, is that one way you can do it?
Yep, or you reduce the terminal discount rate, or you increase the expected growth rate in the cash flows to get the terminal value. So the terminal value is huge in the ability to manipulate the decision-making by the investment committee. Okay. The real estate, again, this is our Mission Bay project. Alexandria is gonna develop this project in Mission Bay. Go for it, I'm sorry.
When you're like checking your assumptions and changing growth rates and stuff, is there a certain like ethical line of changing?
We just know that, you know, a lot of these growth rates cannot be 15%, right? 5 is probably as high as you can probably go. You know, you can go down to 1, but if you go to 0, you're doing perpetuity.
So for like IBM, you would know you couldn't use a certain.
You couldn't use a very high, no way, because it's not a high growth tech company that's newly emerging, that's entered the market and is in a hockey stick valuation or hockey stick, you know, revenue growth
So
curve.
if you said 5% a year, someone would go, you're crazy. We're not.
Probably. So it's not, I don't think it's probably more industry standard and underwriting standards, but when the growth rates are too high or the terminal discount rates are too low on the back end, they try to bury it over there and to see if they can get it through in some cases. Yes, that's unethical. You should be using standards, and they should be reasonable assumptions, okay? The question is how much detail is the board or the investment committee looking at the underlying assumptions of the acquisition?
We do the iterations one more time, so it's.
Yeah, so the first one is, it's a straight iteration. If it's a negative net present value, you're gonna reject it, okay? And if you really want the project, then what's the next thing you would do? What would be the second iteration?
Renegotiate.
You renegotiate the price down or reduce the cost, okay? If you still get negative net present value, what would be the third iteration? You go back and review your assumptions. If you're still getting a negative net present value, then what's the fourth iteration?
Net present value.
You calculate the net present value based on what? The real call option valuation. Okay, so you would calculate the real call option value. Okay, and if the real call option value is equal to or greater than the negative net present value, would you accept or reject it? You would accept it. If the real call option value is equal to the negative net present value, then your net present value is what?
0.
It's 0. And would you accept or reject it?
Accept.
Accept it, exactly.
Why do you want it so bad if it's 0?
Because there's factors that are in that acquisition or in that asset or in that project that's not being reflected in the simplistic assumptions that you're making using the discounted cash flow approach. There's other factors that aren't being captured, and you don't want to miss a good opportunity because your modeling is limited. Okay? Okay? So let's do the real estate. So last year, the net operating income, and again, we use net operating income. Last year was 125 million. We know that for the Gordon growth model, the going in growth rate is 2% and the terminal is 1%. The gross potential rental income next year is $150 million. The expected return of the discount rate going in is 12%, the terminal is 14%. The pro forma cash flow growth rates, 10%, 8, 5, 2, 2, and 1. Cost of the development is 1.25 billion. So, and it's a 5-year holding period. So So in this case, you're not doing 3 years, we're doing 5 years. So you're gonna have to grow it out 5 years, 6 years, apply the Gordon growth model. Again, you got your terminal discount rate at 14%, you got your terminal growth rate at 1, so you're gonna apply 0.13 to that 6-year cash flow. Go ahead.
So once you find out your net present value, are you gonna subtract the 1.25 billion from it?
No, the present value.
So you subtract that from the present value?
Once you get the present value, then you subtract the cost of the construction, or the development cost, or the acquisition price, okay, to get the net present value. And again, if the net present value is negative, do you accept or reject it? If the net present value is negative, do you accept or reject? Reject. If you really want the project, what's the first thing you would do?
Renegotiate.
Exactly, renegotiate the price or reduce the cost in the amount of what? In what amount? The amount of the negative net present value. And if you can't get the price or the cost reduction, then what do? Check your assumptions, and if that doesn't work and you still want the project, then what do? You calculate the real call option. And if the value of the real call option is equal to or greater than the negative net present value, do you then accept or reject it? Accept it. Okay. So I'm just trying to go through the logic over and over again. Okay. I was going to ask you to, for extra credit, in these two analyses, you can apply the perpetuity model or the Gordon growth model to the T+1 cash flow, right? Because I can get the value that way. We can get the present value using the discounted cash flow model. Can I also take, like in this case, the net present value, grow it out 1 more year, and then apply the expected return to that to get the value? Could I also take the next year's net operating income and divide it by I minus G to get a valuation? Can I also take the, here I already have the, what do I have, the gross potential rental income. Well, I already know what the cost of construction is, 1.25. I can divide that gross potential rental income by the cost of construction to get a multiplier. Apply that to the net operating income next year to get a valuation. Can I do that using the multiple approach? And then do the DCF. So I could actually calculate the 4 valuation methods, not only for the piece of real estate, but also for the company.
Are you gonna want us to go back through it and weight them after?
No, I'll do that on the last one. Because the first case study here is just investment banking. We're taking over a company. The second one is a real estate investment banking approach. And then the third one is the stock valuation. So the third one is we're going to buy a tech company stock. Last year, the earnings per share was $13. We know that the growth rate for the first year is 5%. So we can grow that out. My expected return going in is 8%. And my growth rate going in is 1%. So 8 minus 1. And then the next year's earnings per share, I can get the Gordon growth. I have next year's earnings per share, I can divide it by the expected return, I can get the valuation. I already gave you, I think in years, I don't think I gave you the multiple. Maybe write down the multiple. I'm going to use a 15 multiple. So if you know next year's earnings per share and you know that the multiple is 15, can I multiply the 2 to get the valuation? Yeah. And then the discounted cash flow, we already have the growth rates for the 6 years. We know what the terminal expected return is, 10%. We know the terminal growth rate, 1. So you're going to apply the Gordon growth to the 6 year to get the terminal value, and then discount the earnings per share back to get the present value. The current stock price is $157. So if your present value is higher than the current stock price, what would be your recommendation? If the present value you get for the stock is higher than the current stock price, what would be your recommendation? You would buy it. If it's equal to,
Buy it.
you would hold it. And if it's less than, you would sell it. If the present value is higher than the current stock price, what trades could you recommend?
Sell short.
If the present value of the stock is higher than the current stock price, which means the current stock price is probably going to go up. So what would be your trade recommendations? Now you're making recommendations to your client. So the first thing you would do, no, but let's start with the stock.
Buy on margin.
So I would buy the stock. My recommendation would be to buy. And the second one would be buy on margin. The second one would be buy calls
Right.
and write puts. Those would be the first four. Okay. And if that stock is a major component of the indexes, could I buy exchange traded funds? Yes. So what would be the recommendations for the exchange traded funds? Buy, buy a margin, buy calls, write puts. So there's 8 trades right there. And then if you could buy forwards and futures and calls on futures and write puts on futures for indexes, what would be the trades there?
Did you decide?
I just said it. You know, you buy the forwards, you buy the forwards, buy the futures, buy the calls on the futures, write the puts on the futures on the indexes. Okay, and there's another 4. So how many trades are we at now? We got 12. Okay, now those are the recommendations that you would make to your client. Would be those 12.
We're gonna write, you want us to put those down?
Yeah, that'd be great. If you want to, I'll give you extra credit for that. Okay, but I'm really looking for is, do you know how to do the discounted cash flows, right, in the 3 methods? Do you know the valuation methods? And then the last is, you know, putting together that, how are you? The last is putting together the, matrix, right, the investment decision-making matrix. Price is greater, sorry, present value is greater than price. Present value is equal to price. Present value is less than price. Net present value is positive. Net present value is equal to 0. Net present value is negative. The internal rate of return is greater than WACC. Internal rate of return is equal to WACC. Internal rate of return is less than WACC. Break even is greater than 3 years, or less than 3 years, equal to 3 years, and greater than 3 years. So that the acceptance, accept, accept, reject. Accept, accept, reject. Accept, accept, reject. And if your negative net present value is negative, what's the second iteration?
Reject, 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 reject.
No, you would, if the negative net present value was negative, what would you do on the second iteration?
Oh, the ratio.
Yeah, so you write that in. Then the third iteration, check your assumptions. Fourth iteration, real call option. So I'm looking for that grid. Okay.
You want, how do we put the, like, accept, reject for the iterations out? Do you want?
You just write the notes in. Just write in that if the negative net present value is negative, I would ask for a price reduction or reduce the costs.
Okay, you don't necessarily have to write reject, reject.
No, you don't have to do that. I just want to know that you know the iterations. And then if you have a negative net present value, and you really want it, you get the cost price reduction, assume the assumptions, and then calculate the real call option. Okay? So it doesn't, I just want to know that you have that logic. Okay. You know what, the computer doesn't work.
Oh, that's fine.
Both of them.
Huh,
So I got 2. You probably needed the,
I do. Hold that thought, I'll be 5 minutes.
okay. Does everybody know Sarah? You need to work with Sarah. Okay, she's the guru of data, financial data, so that when you're doing the research on the case studies, she's gonna help you find the financial ratios and the capital structure and press releases and, you know all the estimates and earnings per share and, everything around the companies. So I would work with her. If you don't already know how to do the research, does everybody know how to do the research from the library? How many people are comfortable in doing stock research through the library? Okay, perfect, that's why we got her here. Okay, that's why she's here. Okay, so I can't do the PowerPoint presentations but let me just go through off the top of my head. So the capital structure was one which we already went through. Stock valuations were the others. Portfolio theory, the chapter on Modigliani Miller. You want to write this down, okay? And this is critical. In the Modigliani Miller hypotheses, and to get right to the chase, basically the capital structure of the firm is extremely important. It doesn't really determine the value of the company, but it does have an effect on the value of the company. The more leverage a firm takes on through debt, the higher the cost of the debt and the equity. So there's a point in which a firm can take on debt. It kind of goes like this, and this is the value of the firm. This is the value of the firm, and this is the either debt to equity or the debt to total market cap. So as the firm starts to take on more debt, can I deduct the interest on the bonds? Can I deduct the interest on the bonds? Can I deduct interest on bonds?
Yes.
Can I deduct the interest on the bonds? If I issue bonds and I pay interest on those bonds, can I deduct the interest?
Yes.
Yes, I can. Okay. So does that create an incentive to use more debt? Does that create an incentive to use more debt? If I can deduct the interest on the bonds? Yes, it does. Yes, it does. So firms are incentivized to take on more debt because it's cheaper because of the tax sheet. Okay? Because of the tax sheet. You're incentivized to take on more debt. But there's a point in where if they take on too much debt, there's too much financial risk in the firm. And if the firm is subjected to a downturn and its earnings start to drop, then they may not be able to pay the interest on the bonds. And the bonds will go into default. And the company could go into bankruptcy. So there is a debt level, an optimal debt level that firms can take on. And if they go beyond it, it actually starts to cause the cost of capital to go up exponentially, because the shareholders and the bondholders want to be compensated for the increase in financial risk that the firm is imposing on them by over-leveraging the firm. So there's an optimal level of debt that a firm can take on that would maximize the value of the firm. If they go beyond that, it destroys the value of the firm because the cost of the debt and the equity goes up exponentially.
So if the company's taking on more risk than,
More financial risk.
than the stockholders are gonna demand more.
They're probably gonna sell. They're gonna either sell the stock or they're gonna demand a higher rate of return. And remember, in the perpetuity model or the Gordon growth, if the expected return goes up, the stock value goes down. So if they take on more debt, the discount rate or the expected return goes up and the values go down. And it affects both the bonds and the stocks. But there's a prudent amount of leverage that firms can use through the optimal capital structure, the target capital structure, the weighted average cost of capital, that will minimize the cost of capital and maximize the value of the firm.
Who has first call on the dividends? Is it the stockholders or the bondholders?
Now, the bondholders have the first claim to the earnings.
Is that why it's less risky?
And if there's not enough money left to pay the dividends, they're not gonna do it. Did you plug yours in?
Yeah, I can just walk everybody through it if they've got
Yeah.
computers.
Oh, did you get it?
Yeah, I can't get it to display, but I can walk, they've all got computers.
Yeah, exactly. So tell them where to go.
Okay.
We're gonna spend like 20 minutes going through where to get the financial ratios and stuff.
There's 10 minutes left.
Is this a good switch over spot?
Yeah,
So-
that one's dead, that one's dead.
Plus, you got 10 minutes left.
Yeah.
She can do it in
I can do it in 10. Okay, so I'm gonna stand in the back and yell at you, so,
perfect. least
Go to
it's
the
not me
library's
this time.
homepage, you should all know how to do that.
You can turn it on.
See, I'm standing